Alright, what's going on, everybody? It's Sebastian here, and today, to begin the new semester, in this video, I will be going over the brief exercise problems for Chapter 1 of Accounting 101. This is for students that use Wiley Plus for their homework. This is not for students that use McGraw. Let me make that very clear. So with all that being said, let's get started. Match each of the following terms of business organization with a set of characteristics: sole proprietorship, partnership, corporation. A. Shared control, tax advantages, increased skills and resources. This describes a partnership. Simple to set up and maintains control with the owner. That's the sole proprietorship. Easier to transfer ownership and raise funds, no personal liability. That's a characteristic of a corporation. Match each of the following types of evaluation with one of the listed users of accounting information. And real quick, I'm going to get rid of this. Boom. So A, investors of common stock. So what they are looking for is trying to determine whether the company's net income will result in a stock price increase. Usually, depending on the profit of a company, their stock price is going to go up if the net income is positive, or it's going to drop if there's a net loss. So it depends. Marketing managers, what are they looking for? Well, they are looking to see if an advertising proposal will be cost effective, meaning that it is reasonably priced for them to do. Creditors, the parties that loan out money or loan out goods and will be owed back. What are they looking for? They are trying to determine whether the company can pay its obligations. This goes for suppliers that supply goods and services. This goes for credit unions. This goes for banks, and so on and so forth. The Chief Financial Officer, CFO, they are trying to determine whether the company should employ debt or equity financing. And by financing, they're talking about how they should try to obtain cash in order to start their business. This could be through debt, such as a loan or a bond, or through equity from shareholders on the outside. It's up to the CFO to decide that, and there's various ratios and things of that nature that we'll be discussing later on in this class. Finally, the IRS, the Internal Revenue Service. They are trying to determine whether the company complies with the tax laws. Indicate which part of the statement of cash flows each item would appear: operating activities, investing activities, or financing activities. The cash received from customers, that's an operating activity. These are the activities that go on during a regular basis for the company when they are running their business, and cash received from customers is an example of that. Cash paid to stockholders in the form of dividends, this is a financing activity. They are financing cash to the shareholders who invested in the company by paying out a dividend. This could be a set amount, or this could be a percentage depending on what they choose. Cash received from issuing new common stock, that's another financing activity, as the consumers are financing the company's operations by giving them cash, and in exchange, they get ownership over the company partially. Cash paid to suppliers, that's an operating activity. And finally, cash paid to purchase a new office building, this is an investing activity. The main difference between operating and investing activities is that investing activities involve larger plant assets that they are going to use for a long time, such as equipment, buildings, or land, and it also involves buying and selling long-term investments versus operating activities where they purchase goods, they receive cash from customers, they pay interest, they pay income taxes, so on and so forth. Stuff that happens on a regular basis and doesn't cost as much. All right, hold on, let me do that. Presented below are a number of transactions. Determine whether each transaction affects common stock, dividends, revenues, expenses, or does not affect stockholders' equity. Provide titles for the revenues and expenses. Transaction A. Costs incurred for advertising affects expenses. The account title in question is advertising expense. Cash received for services performed affects our revenues, specifically service revenue. Costs incurred for insurance, that's going to be an expense, specifically insurance expense. The amounts paid to the employees, that is an expense, specifically salaries and wages expense. Cash distributed to stockholders, that affects dividends. The account title here is not applicable. This is because we are only looking for account titles for revenues and expenses. Dividends, that is a cash payment to stockholders outside of the company versus an expense. That's the cost of resources or services used inside the business. That's the difference. Cash received on exchange for allowing the use of the company's building, this is a revenue. Specifically, this is rent revenue. They are allowing someone to use a space inside their building, and in exchange, they are receiving cash. They are getting paid cash to allow someone to rent a part of the building. Costs incurred for utilities used affects our expenses, specifically utilities expense. Utilities include water, heat, light, electricity, so on and so forth. Cash purchase of equipment, that does not affect stockholders' equity at all. And because it doesn't affect it, the account title as it relates to revenues and expenses is not applicable. Finally, cash received from investors, this is considered common stock. And because common stock is not a revenue that is earned by the company, that is not applicable. The difference between common stock and revenue is that a revenue is earned by the company through services, through rent, through interest, and other forms of revenue. But common stock, that's the kind of cash that is given to them from investors. It was not earned, it was given. That's the difference. In alphabetical order below are balance sheet items for Carroll Company at December 31st, 2022. For this problem, we will prepare a balance sheet. So what a balance sheet is, it is also known as the statement of financial position, where we review a company's assets, the resources that they own, the liabilities, any obligations to third parties that they must pay, and stockholders' equity, which is the stockholders' ownership over the assets, their claims to assets. So for the balance sheet, we're going to put the date December 31st, 2022. What do they have? So what do they own? What do they owe? And what do the owners have access to? So in terms of assets, we're going in terms of liquidity, which is how liquid they are in terms of cash. Cash is going to go first. So cash is 22,000. Now, accounts receivable is next. What accounts receivable is the cash that is owed from customers that is expected to be paid. That is $71,000. Then the total assets here, we're going to sum these two up to get 93,000. For the liabilities, we have accounts payable. And accounts payable is the exact opposite of accounts receivable. So from our point of view, it's the money that we owe to creditors from a third party, such as a supplier of goods. That's going to be 65,000. Next, there's stockholders' equity. The first item is common stock. That's the cash received from investors. That's going to be 18,000. Then we have retained earnings. Those are the profits that we earned and held for future use. That's going to be 10,000. And we'll learn about the retained earnings statement soon. Next, we are going to add up our total stockholders' equity. So we'll sum up the two here in dark blue to get 28,000. Then for total liabilities and stockholders' equity, we'll add our accounts payable plus our stockholders' equity to get 93,000. There's a couple things you should notice about the balance sheet right away. Number one, the total assets equals the total liabilities and stockholders' equity at all times. And the reason for this is because of the accounting equation. Assets equals liabilities and stockholders' equity. What this doesn't mean is that they are the same thing. They are just equal in value. What you own in assets must equal to what you owe in liabilities and what owner's capital you have in stockholders' equity. They are equal in value. And something else that you should notice. If you take the total assets and take away the total liabilities, that is another way of finding stockholders' equity. Keep that in mind. Because let's assume we take all of our assets and they get converted to cash and we pay off all of our liabilities, right? The total stockholders' equity, that is the net worth of the company. Because think about it. The common stock, that's what was given to the company. And then the retained earnings, that is their net profit that they kept over time without paying some of that back to the investors through dividends. So whatever's left over in profit that they kept, that's part of their net worth, not to mention common stock. Eskimo Pie Corporation markets a broad range of frozen treats, including its famous Eskimo ice cream bars. The following items were taken from a recent income statement and balance sheet. In each case, identify whether the item would appear on the balance sheet or income statement. All right. So for income tax expense, that's an income statement item. It's an expense. Inventory, that goes on the balance sheet as an asset. Inventory, that's the stuff that you buy at a certain price from, let's say, a wholesaler, for example, and then sell later at a higher price to customers. For example, with Walmart. Accounts payable, balance sheet item under liabilities. Retained earnings, that's a balance sheet item under stockholders' equity, like you saw in the last problem. Equipment, that's a balance sheet item that is an asset. For example, your phone or a car or a truck, something that you're going to use to the benefit of the company for years to come. Sales revenue, that is an income statement item. Cost of goods sold, that's income statement. That's considered an expense. Cost of goods sold is exactly what it sounds like. It's the cost to acquire the goods that you was able to sell. Common stock, that's a balance sheet item under stockholders' equity. Accounts receivable, balance sheet item under assets, and then the interest expense is an income statement item. So in summary, income statement items include any profits, aka revenues, and any losses / expenses. Usually it has the word expense, with exception to a couple items like cost of goods sold or loss on disposal of plant assets or land. More on that in chapter 9. Indicate which statement you would examine to find each of the following items between the income statement, balance sheet, retained earnings statement, or statement of cash flows. Revenue during the period. You would look to the income statement for that. You would check, say, your service revenue, sales revenue, rent, interest, or any other kinds of revenue throughout the period. That's the statement that you would check. Supplies on hand at the end of the year, that's going to be in the balance sheet because supplies, that is considered an asset. For example, pen, paper, erasers, stuff that you're going to use and dispose of that you buy in bulks. Those are some examples of office supplies. Some other examples, paint brushes, and among other things. Cash received from issuing new bonds during the period. You would think it's the balance sheet, but it's actually the statement of cash flows. And here's why. Because cash is the most liquid and volatile asset there is. It comes and goes, right? You spend cash to acquire assets or to pay off debts or expenses, and you gain cash by performing services and other things. So in order to figure out how much they received from issuing new bonds, it would be best to check the statement of cash flows because that breaks down the operating activities, investing, and financing activities, among other things. More on that in chapter 12. Total debts outstanding at the end of the period, you would check the balance sheet. So another way to say debts, another word for that is liabilities. And debts outstanding means any liabilities that have not been paid. Those will appear in the balance sheet. Use the basic accounting equation to answer these questions. So before we get into this one, we need to remind ourselves what the accounting equation is. It's assets equals liabilities plus equity. But with these problems, you're going to see that we're going to have to mix up the equation a little bit. You'll see what I mean in a second. The liabilities of Lance Company are $90,000 and the stockholders' equity is $230,000. What is the amount of Lance Company's total assets? In order to figure this out, we'll sum up the total liabilities plus equity to get the total assets of $320K. B. The total assets of Saley Company are $170,000 and its stockholders' equity is $80,000. What is the amount of its total liabilities? So we'll take the assets minus the stockholders' equity, and that equals liabilities of $90,000. So essentially what's happening with the equation here is we know our assets on the left side and we know the stockholders' equity on the right side. But what we don't know yet is the liabilities. So in order to rearrange the equation, we take the stockholders' equity to the other side on the left and take that away from the assets to find the missing liabilities. The total assets of Brandon Corporation are $800,000 and its liabilities are equal to 1/4 of its total assets. What is the amount of Brandon Corporation stockholders' equity? The first question we should ask is how much is 1/4? Well, if you do 1 divided by 4, you'll see it's 25%. So assets times the 25%, that equals liabilities of 200,000. And again, like in B, we know 1/2 of the liabilities in equity now. We know our liabilities. We also know what our assets are. So what we need to do is take the assets and subtract the liabilities, move it to the left side of the equation to get the missing stockholders' equity, which is 600,000. At the beginning of the year, Morales Company had total assets of $800,000 and total liabilities of $500,000. Treat each item independently. Let's say that total assets increased $150,000 during the year and total liabilities decreased $80,000. The question here is what is the amount of stockholders' equity at the end of the year? So we'll report our total assets and our total liabilities. So knowing that, we can figure out the total stockholders' equity at the beginning of the year. So 800,000 minus 500,000, that equals 300,000. Now, if we take the beginning balance in assets and we add the increase of 150,000, that means the ending balance is 950K in assets. In liabilities, 500,000 minus $80,000, that equals 420,000. So if we take the difference, say we hit tab, this is on a MacBook, otherwise you would just subtract, that's $530,000 in stockholders' equity. So what caused this increase in stockholders' equity? Well, for one, we had an increase in assets and resources that the company owned, and a decrease in liabilities, which means that more of our liabilities got paid off. And so for those two reasons, that explains the increase from 300K to 530K in equity. But let's say instead total liabilities increased by 100,000 and total stockholders' equity decreased 70,000. What would be the amount of assets at the end of the year? Well, so we're assuming that our liabilities are going up 100,000, which means that it's going from 500 to 600,000. Then the stockholders' equity, we are assuming that that's dropping by 70,000, which means we're down to 230K. So now if we take these two and sum them up, that equals 830,000 in total assets. So it went up by 30,000. How did this happen? Well, for one, we increased our liabilities by $100,000, probably by borrowing some money and buying some stuff on account. More on that later. And then stockholders' equity dropped by $70,000. But let's say, for example, in C, that assets decreased 80,000 and stockholders' equity increased 100,000. What's the total liabilities at the end of the year? All right, so if assets are dropping by 80,000, it's going to decrease from 800,000 to 720,000. As for equity, if it's going up 100,000, it should go from 300K to 400K. That means the total assets minus the total stockholders' equity, that equals the total liabilities of $320,000. All right. Indicate whether each of these items is an asset, a liability, or part of stockholders' equity. Accounts receivable is an asset. Salaries and wages payable is a liability. And it's because it has the word payable in it. So if you see the word payable, you can safely assume it is a liability. Equipment is an asset. Supplies, that is an asset. Common stock, that's a part of stockholders' equity. And then notes payable, that is a liability. And finally, which is not a required part of the annual report of a public traded company? Is it A, the statement of cash flows, B, the notes to the financial statements, C, management discussion and analysis, or D, all of these are required? The answer, we go back. The answer here is that, okay. All right, so the answer here is that they are all required. So let me put that in. There we go. So yes, all of these are required. So the statement of cash flows, that explains the change in cash flow from period to period. The notes to the financial statements can disclose any information such as the interest rate or a change in the company's cost flow assumption in terms of inventory, the management discussion and analysis that is used to analyze the data, the financial statements, to try to make any improvements. That's going to do it for all of the brief exercise problems. We will be talking about some of the regular exercise problems soon. I will see y'all then.